Hey friends, Christy McGowan with Next Home Our Town here today to discuss why there's no reason to panic over a housing bubble because of today's lending standards. Today, some are afraid the real estate market is starting to look a lot like it did in 2006, just prior to the housing crash. And one of the factors that they're pointing to is the availability of mortgage money. Recent articles about the availability of low down payment loans and down payment assistance programs are causing fear that we're returning to the bad habits seen 15 years ago. So let's alleviate these concerns. Several times a year, the Mortgage Bankers Association releases an index titled the Mortgage Credit Availability Index. And according to their website, the MCAI provides only standardized quantitative index that is solely focused on the mortgage credit. The MCAI is a summary measure which indicates the availability of mortgage credit at a point in time. Basically, the index determines how easy it is to get a mortgage. The higher the index, the more available the mortgage credit becomes. So here's a graph of the MCAI dating back to 2004, when the data first became available. We can see the index stood at about 400 in 2004. Mortgage credit became more available as the housing market heated up, and then the index passed 850 in 2006. When the real estate market crashed, so did the MCAI to below 100, as mortgage money became almost impossible to secure. Thankfully, lending standards have eased somewhat since. The index, however, is still below 150, which is about 1/6 of what it was in 2006. So why did the index rage out of control in the housing bubble? Well, the main reason was the availability of loans with extremely weak lending standards. To keep up with demand in 2006, many mortgage lenders offered loans that put little emphasis on the eligibility of the borrower. Lenders were approving loans without going through a verification process to confirm the borrower would likely be able to repay the loan. Some of these loans offered attractive, low interest rates that increased over time. The loans were super popular because they could be obtained super quickly and without the borrower having to provide documentation up front. However, as the rates increased, borrowers struggled to repay their mortgages. Today's lending standards are much tighter, as Investopedia explains. The risky loans given at that time are extremely rare today, primarily because lending standards have drastically improved. In the aftermath of the crisis, the U.S. government issued new regulations to improve standard lending practices across the credit market, which included tightening the requirements for granting loans. As an example of the relaxed lending standards leading up to the housing crash, the FICO credit score associated with a loan. What's a FICO score? Well, the website MyFICO explains. A credit score tells lenders about your credit worthiness, how unlikely you are to pay back a loan based on your credit history. It's calculated using the information in your credit score, and FICO scores are the standard used for credit scores used by top 90% of the top lenders. Ugh. During the housing boom, many mortgages were written for borrowers with a FICO score under 620. And Experian reveals that in today's market, lenders are way more cautious about lower credit scores. Statistically speaking, 28% of consumers with credit scores in the fair range are likely to become seriously delinquent in the future. Some lenders dislike these odds and choose not to work with individuals whose FICO scores fall within this range. So there's definitely still some loan programs out there that allow a 620 score. However, lending institutions overall are much more attentive about measuring risk when approving loans. According to Ellie Mae's last Origination Insight report, the average FICO score of all loans originated in February was 753. And this graph here shows the billions of dollars in mortgage money given annually to borrowers with a credit score under 620. In 2006, you can see mortgage entities originated $376 billion in loans for purchasers with a score under 620. Last year, that number was only $74 billion. Bottom line, 2006 lending standards were much more relaxed, with little evaluation done to measure a borrower's potential to repay their loan. Today's standards are tighter and the risk is reduced for both lenders and borrowers. As a matter of fact, many of our clients today who have not purchased a home in 5 or so years are flabbergasted by the new requirements. These are two very different housing markets, so there's no need to panic over today's lending standards. If you have more questions about this topic or other real estate interest, we really do love it when folks like you reach out to us. So go ahead and text me at 254-271-1354. Thanks so much for watching, and happy Easter.